he has been a friend of MBBI in Chicago. Victory Park has been very active recently, judging by all the recent emails of new financings and new acquisition capital providing to some of our smaller tier private equity funds and for their direct account. It's a pleasure for me today to introduce Jordan Ellen. Thank you.
Thank you. Yeah, we've been busy. We've been really active in a number of different spaces, particularly lending to lending platforms. So you've probably all seen the recent IPOs of a company called Lending Club and On Deck, and we actually do provide capital to On Deck. We don't to Lending Club, but we provide capital to a very similar company called Prosper. And that whole industry has sort of grown out of the crisis, where whether prompted by the regulators or sort of given what happened with subprime in the crisis, most of the banks in the U.S., particularly the bigger banks, have said they're really not interested in financing small businesses or consumers. And so there's been a plethora of platforms that have built up, and we estimate that right now the online lending space at a little bit over $20 billion. Still small when you look at the $1 trillion of debt that we have in the U.S., non-mortgage, non-real estate debt, but certainly growing. And so we've been providing capital to that sector since 2010, and we now have a little bit over $1 billion. So that's been a big part of our business. The other part of our business is a little bit more conventional private equity, private debt, middle market focused. We say sort of $25, $30 million EBITDA and below, although I think if you looked at the average EBITDA of our portfolio, it's probably half of that. We have a couple different funds from which we allocate, and we like that. So we have a fund dedicated to the specialty lending space. We also have a fund focused on private debt or private equity investments, sort of 40 million and up. And then we have an SBIC fund as well. So we like being able to sit down with a company and talk about what their needs are rather than trying to sell them what we have. What do you need? And we can sort of provide both debt and equity combination. And so we found that to be a pretty good model. In terms of, and I am a lawyer, but I'm technically in a retired status with the Illinois Bar, so there'll be no legal advice or comments today. We started the firm in 2000. My partner started the firm in 2007. Richard, Levy, Brendan, Carroll, and Matt Ray started. They came out of Magnetar, where they were running the private solutions group. As Greg mentioned, I joined about 2 years ago from Man Investments, the large British money manager. I was living here in Chicago and running the business in New York, so it was a lot of back and forth. And our fifth partner, Jason Brown, joined us just this year from GE Capital, and he's based in Los Angeles. So with him in Los Angeles, we have one guy in New York, one guy in San Francisco, actually one gentleman in London. We have pretty good coverage for various different sectors and the regions. I think a lot of times people ask me, what do we do? And I think the best way to describe it is we're a middle market capital provider. We're sort of agnostic as to strategy, although I'll tell you where we concentrate. And I think in that space we really tend to be a value or credit-focused investor, because we'd always rather be inside the assets. We're happy to be a combination and happy to look at cash flow as well, but typically we want to have at least some downside protection from the assets. A big part of our success, or whatever we've had, is really from sourcing, and a lot of it comes from people in this room and your brethren. So last year we saw over 1,000 deals, and that's key. I say all the time, you got to kiss a lot of frogs to find that prince. And so we're looking at deals all the time. We pride ourselves on being a good partner with the brokerage community. We're not getting the calls from Goldman and Morgan, the big guys, we're getting calls from the middle market guys. And we review the pipeline every week, and we try to give a very quick decision and indication whether we're interested. We also like doing complex deals, and I think we'll talk a little bit about that as well, but that's sort of become a big area for us. So why the middle market? I'm sort of a data hound. I look at a lot of the data in the industry, and this is one that always is sort of interesting to me. If you look at sort of the percentage of loans, I don't know if you guys can see that, but the overall percentage of middle market loans last year was like 100 basis points of the overall loan market. And so what that means is there's just less competition, there's just less competition in that space, which is good for guys like us. And what that means also is that you have a little bit more pricing power. So this shows both the institutional and pro rata tranches of the loan market, but it gives you the sense that with a little bit less competition comes the ability to drive pricing. So what's our philosophy? Sort of how do we go about looking at an investment? I have some notes here. So there's a couple different things that I think are important to note. First of all, because we're focused in the middle market, and I already mentioned that we like to look at the assets. Not an ABL guy, but we like to look at the assets. We want to make sure that there is some protection on the downside, and we do that typically by capitalizing the business with our own debt. So we'll go in and we'll provide both debt and equity in a typical sort of distressed or real significant turnaround situation. We typically are not using outside capital because we want to control the process. Almost every time we go in, there's some process, there's a story. It's either a bankruptcy or lately we're doing a lot of ABCs. There's a lot of, every time there's a story. Typically it's around management or some sort of catalyst. And usually these things are not sort of a straight climb from the bottom. There's usually a zig and a zag along the way. And we'd rather not deal with an outside bank or an outside leverage provider. Once we get things turned around and stabilized, we'll often go out and refinance the company, but we'd really rather control the balance sheet and not have to answer to anybody while we're going through the value cleanup and value creation process. So we really are not focused on leverage in the first instance. We are always focused in on buying right. And buying right really starts, as I mentioned, from the sourcing side, right? I mean, we get paid to do deals. We'd rather do the good ones over bad ones, and the best way to find the good ones is to look at a lot. So that's a very big part of our focus. The other thing that we think we're pretty good at is complex deals and also creating value within the structure. We have a number of guys that have operating experience. I've been involved in a lot of different operating companies, and several of my partners and a bunch of our senior guys. And in many cases, we'll supplement it with outside resources as well. In fact, almost every time we'll supplement with outside resources. And so we don't necessarily have a bench of operating partners like some of the bigger venture firms do, or some of the bigger private equity firms do. But we do have a very good network, and we focus in on certain sectors, and we know where the talent lies. And then ultimately, we're trying to get out at a higher basis than we got in. Pretty simple, sort of get in cheap inside the assets, try to fix the business, and then ultimately monetize. So where's our value add? So I touched on that a little bit in the last slide. But I have to say, I think that the value add that we have is largely created through being focused on certain sectors. And so rather than trying to boil the ocean, so if you look at our marketing materials, it says we'll look at anything, right? Because we want to see as many deals as we can. But if you look at our portfolio, it's very lumpy. In certain sectors, the common theme being they tend to be higher cost of capital industries. Food services, we own Giordano's here in Chicago. I'll talk about that a little bit later. We own a business out on the West Coast, fast casual Mediterranean. We used to finance Jamba Juice. We have a couple other investments in the food sector. We like retail. I don't know if you guys remember the old Fuller Brush business. That's our portfolio company. We finance Joe's Jeans and Hudson Jeans. And we have a number of other businesses sort of that face the retail consumer, including a Hispanic grocery store, which I'll talk about in a minute as well. We like transportation. We like energy, particularly energy services. You know, generally try and stay away from the commodity side of things, but we like sort of the production side. And by being deep in those sectors, A, you see better deal flow, particularly proprietary deal flow. B, you're smarter on the way in. C, you're better if things go bad. You know where to go to, within the network. And ultimately, you're also better on the way out because you know the bankers and the brokers on the way out. So our promotional materials say we do everything but real estate and tech, but in reality, our portfolio is lumpy in those particular sectors. And I think that gives us an edge. It just makes us a better investor. Happy to take questions along the way if you guys want.
Sure,
there you go. Didn't even plant that.
sectors to go into, do you do that based upon the expertise of your people on board right now, or in sectors where you think there's opportunity?
Yeah, that's a good question. A little bit of both. I mean, some of it is reactive and some of it is proactive. So so for example, we saw a couple years ago, this actually predated my experience, but my partners had an opportunity to get into the energy services space. They actually went out and brought in a guy with real experience in that space. He's joined our team, will actually be a partner probably next year. We also, on occasion, will sort of thematically come up with ideas that we find interesting. We happen to dabble in, up until recently, in the Hispanic consumer space. One of our portfolio companies is a group of Mundo Fox affiliates, one in Las Vegas and one in San Antonio. So we sort of got familiar with sort of the whole Hispanic movement and the increasing purchasing power that community has. So we actually started looking for businesses in that space. And one of our guys started spending a lot of time on it, got very smart, found a couple operators that he liked, and then we were able to execute. We bought the Mi Pueblo business out on the West Coast earlier this year. So it's a little bit of both, but I would say it's, we're probably, equal thoughtfulness and equal, opportunistic. So in terms of sourcing, because I think that's relevant, particularly to this group. Like I said, we sort of cover the globe. We tend to give. So we're holistic in our sourcing. We don't have just a business development guy. That's actually not true. I have one business development guy just focused on the specialty lending space out in San Francisco. But aside from that, all of our investment professionals and the partners are involved in the sourcing process. I've been around for a while. I've been in the business for a long time. I spent 12 years working for Zell. I have a lot of people who I know. And so I get a lot of inbound calls, as do my partners. But each of our, like the next tier of investment professionals are assigned by sector: energy, specialty lending, transportation, et cetera. And then they're also assigned a region, pretty much correlating to where those sectors lie. And they're expected to get out and attend the conferences and meet with the brokers and figure out who's active in the space and know the competitors. It's a pretty significant expectation. We have a really robust sourcing process. We have we have a process where things come in, they get input to our database. We use this Microsoft system that's actually fairly mediocre, but we've sort of built around it. And it's as soon as something's distributed within 24 hours, it's kicked out to the investment professionals. And the guys know which ones they are supposed to pick up. If for some reason it's unassigned, and if not, either me or my partner will assign it to somebody, if it sort of is a tweener. We then meet Monday morning, 7:30 a.m. Everybody's around the conference room. And we've actually recently outgrown our conference room. And we go through deal by deal, fund by fund. And it's everybody. It's the sourcing guys, the investment guys, and the guys that like me on the investment committee. And we right there are sort of the guys are expected to describe the opportunity, to speak to it, and give their sort of preliminary, yes, I'm interested, and no, I'm not. And then the investment committee guys basically decide, does it fit within one of our fund mandate? Is it something we're interested in, or do we pass? And so what we like about that is, we should be able to give you feedback within a week, let's say 2 weeks at the most, once we get the information. So it's a pretty robust process, and it really fuels the rest of the business. So how do we select from there, right? We're seeing all these deals. First we decide, does it fit the fund? Do we have capital in that fund? Is it something that we're interested in? Do we have an edge? Do we have an expertise here? We're not big on auctions and that sort of thing. We will do them. We'll talk about the Giordano's deal in a minute. So we will get involved in an auction from time to time, but usually we're looking for, like everybody else in my shoes, looking for something where we have an edge. And I think the edge for us has been creatively finding entry points. So, we're typically not just buying debt. We don't really buy distressed debt, although we did it a couple times this year because it ultimately allowed us an entry into the business through restructuring. So we do that, although I would say up until this year, we really hadn't done very much of buying secondary paper. But we have inside our firm, our general counsel is a former bankruptcy attorney, a partner from Kirkland & Ellis. One of my partners, Matt Ray, is a super experienced turnaround guy. He's got a bunch of awards from the TMA. Like I said, I spent 12 years working with Zell, including helping him launch his distressed M&A fund back in the early 90s. So, and we have a number of other guys that are very experienced turnaround and workout guys. So entry point for us is very key, and I think it becomes a differentiator. Frankly, the messier the better. We're able to work. I think we feel like we work a little bit harder than the next guy, and are able to be a little bit creative. But again, a lot of that stems from the fact that we tend to be sector focused, right? So I'm not going to do a really super complex deal in a sector that I don't know well. Then there's the value creation process. And here I would say a lot of it, again, goes back to the fact that we're sector focused. We know where to go. We know where the expertise is. We know how to supplement. And it includes third-party advisors. It includes operating partners. It includes supplementing or enhancing management. And so there's really sort of no stone unturned. One of the things that we've been doing a lot lately is on the way in, and then also in the early stages, is working with a firm called GH Smart. I don't know if anybody's heard of them, but they're basically like industrial psychologists, or head shrinkers, and they come in and they basically evaluate your management team. They'll tell you whether where the dynamics are between who likes who and who sort of is who's a problem, how do they work together. And then they'll give you a game plan. So it's not just like critiquing them, they also give you a game plan in how to enhance or supplement the team. It's been very helpful. There's a couple firms like that, but these guys, I would say, are the best that we've seen. And so that's a big part of it, because at the end of the day, like, we've got fancy spreadsheets and we think we're really smart, but really what we're doing is backing management. And the best thing that we can do, or the smarter we can be in sort of evaluating that management team, the better off we are. So we like that resource a lot.
How do you guys get people to take Myers-Briggs test?
Yeah, we do, exactly. So they take tests. They actually, the interview process with GH Smart is a 6-hour interview process. And before that, they actually have a series of questions that they have to answer.
Can you repeat that question, please?
GH Smart, SMART.
Can you repeat that question?
Oh, the last question? He asked sort of how detailed do we get in the test, and are they doing Myers-Briggs tests and those sorts of things. And so yeah, it's pretty extensive. Actually, the guy Jeff Smart wrote a book. You'll find it on Amazon. Actually, it's a pretty interesting book about sort of the executive process, the management process. So we think, yeah, back in the back.
First one using this. Jordan, in the spirit of the management,
Yeah,
given you guys are buying troubled, underperforming companies,
yeah.
either through like ABC, what's your history in terms of keeping that CEO on board after the fact?
Yeah. It's a good question, and it's one that we actually talk about a lot. And often, you're going to find that the person you put in at the time, and this goes for the CEO, but across the board, the person you're going to put in that seat when you're really in a distressed situation is not the guy who's going to be there when you ultimately want to take the business out to be sold. And so that is an issue. Sometimes there's different skills required, right? Sometimes there's the business will sort of grow beyond the person. So I would say that from the time we buy to the time we sell, there definitely is a turnover, maybe a one-time turnover in the management team. You probably see, a full turnover from sort of beginning to end. But every deal is different. And a lot of times we're going in with management, we're just backing an existing team where, they may have just had some hiccup in their business that isn't necessarily sort of mismanagement. But in many cases, we are making a change. And a lot of times the guy you put in at the beginning is not the guy to take it out at the end. Do you have another question?
No, I was more interested in if the CEO of a bankrupt company, are you going to keep him on?
Do we keep them on? So we may keep them on and put them in other situations. So, right. So not so much in the CEO slot, but a lot of times in the CFO slot. We found that CEOs really are, you just need that deep industry knowledge and tribal knowledge that they have. The CFO spot is a little bit more, is a little easier to sort of move around. So you'll see we have a CFO, one of our businesses has been in 2 other businesses in distress situations. And so I think in the CFO spot, you have this. We like 4 guys that are sort of consultants and somewhere within our portfolio companies, and they've all worked on multiple different companies. Bless you. So we talked about buying right. We talked about sort of the value creation process. Typically starts, with the top line, but really throughout the organization. We have a series of operational value creation, and it's part of our going in thesis. So, we don't really go into a business. If we go into a business, the investment professionals are expected not just to have a plan on entry, but also on value creation and ultimately who's the universe of buyers. And so, if you get a look at our investment committee memos, they can be up to 50 pages because we have a pretty thorough requirement that our guys have thought through what are the changes, what are the enhancements that they're going to make, and how do they expect to get out of this, who are the buyers. So a couple of case studies, which I think maybe help sort of illustrate what we've done. Most people here have probably heard of Giordano's. Giordano's was a brand that's been around for 40 plus years. It was started by an Italian family down on the south side. Ultimately was purchased by another family, and that group ran into some troubles, not really on the restaurant side of things, but they actually were involved in some real estate down in Florida and other areas, and it was cross-collateralized with their business. Ultimately, the business was pushed into bankruptcy by the senior lender, and this was actually one scenario where we did go to an auction process. But the edge that we had here is we were called in earlier by the bank group before they went into bankruptcy to try and do an out-of-court restructuring. We thought we got there. Ultimately, the owner pulled it. But during that process, we got to know a couple of the large franchisees. And as part of the deal, they basically contributed their business, their restaurants, into our group. And so when we were bidding on the business, we knew that the EBITDA of our venture was $3 million north of where everybody else was, because we had those franchisees. So we were able to pay a little bit higher premium, a little bit higher price, ultimately got both the operating company and the underlying real estate over on Rush Street. It's been a great investment for us. There we brought a new management team. And this is actually one scenario where we have the same guy in place, and he's going to lead us out to an exit as well. He's been in the business a long time. He actually spent some time with Let Us Entertain You, and then with a couple other groups, including Maggiano's. And he brought along with him a very, very experienced management team. We've doubled EBITDA in the 4 years that we've owned it. We've increased the number of stores. If anything, we've actually grown the number of stores a little bit slower than we had hoped, because the operating team is such perfectionists. They've really sort of insisted that we get the model right before we take it out for growth. And recently we're opening actually in a couple of weeks in Indianapolis. We're going to Minneapolis and Houston, and trying to sort of show the expansion opportunities, and then ultimately we'll take that business out to be sold. But it was a perfect situation where we were able to get in. There was a catalyst. The catalyst was the problems that the owner was having with his other assets, with the other collateral. And ultimately, the business, while tarnished, wasn't really trampled upon. And so by revamping the menu and cleaning up the stores and improving the process, and actually buying back a couple of the other franchise stores, we've really been able to grow that business nicely. And as I said, we have the management team in place. They'll be the guys that cleaned it up and the guys that'll lead it to an exit. So that's been a fun one for us. We actually are going to get one of the nice front spots at Navy Pier coming up. So if you're out there this summer, you'll see that we're going to have sort of one of the premier 2 or 3 spots at the revamped Navy Pier. Probably won't make a lot of money on it, but it'll be a good PR piece. So that's been a great business for us. And we've actually been able to take that team and leverage them into a couple other restaurant investments. So in particular, we bought a business out in the West Coast called Daphne's. It's a terrible name. It's Daphne's California Greek, which, if anybody knows what that means, let me know, because we still don't. So we actually are rebranding it. We're going to call it Yala Mediterranean, and we're looking to create sort of the Mediterranean version of Chipotle. We're not the only ones trying to do that, but I just was out West Coast a couple weeks ago, and I saw the flagship store, the prototype store, and it's great. It's going to be a hit. And so Yorgo, the guy at Giordano's, is on the board of that, but then he brought along another management team, so guys he knew from that worked with him over the years. And so we have an independent team over there, but it's sort of being overseen by the guy who's at Giordano's. The other business that I thought was relevant, because a lot of times people, how am I doing on time, Greg? Am I okay? Okay. A lot of times people ask me, how can you find distress in sort of non-distressed times? And I think Giordano's was intent, so that we were still sort of coming out of the crisis, and it was a carryover from the real estate problems down in Florida. But Mi Pueblo actually is a little bit different story. It's a chain of 20-year stores on the West Coast, started by a Mexican-American immigrant, and the business was actually growing very nicely, maybe a little bit too fast. I mean, he was definitely having some growing pains, but ultimately ran into a problem with immigration. And he had, in his mind, always sort of run things correctly. In the eyes of the immigration services, probably not so much. And they ended up losing about 70% of their workforce in a 6 or 8 month period. And these are people who, not just sort of the middle of the store, the grocery people, those are relatively fungible, but in the Mexican markets, a lot of sort of outside, the outside, the bakery, the butcher, the taqueria, those are really high-touch type positions, and the relationships with the customers and those people running those departments were very, very important, and they had a massive turnover. They went from making a couple $1 million a year to losing a couple $1 million a year, and ultimately Wells Fargo put them into bankruptcy. I touched on earlier the fact that we actually bought paper here. Here we did that. We financed them in the DIP process, which we've done a few times, but we'll only do it when we know that there's an exit where we can get control of the business. And here we partnered with the gentleman who started that business, and we ultimately now own 50% of that business, and we're sort of 55 or so $1 million into it. Ultimately, we'll be able to refinance that out. We're probably 6 months away. But we brought in a new management team. I think I mentioned earlier that this was a theme that we were looking at, and we actually came upon a guy in one of our earlier due diligence processes where we didn't execute an operating guy. And we brought him in as president of that business. He comes from a big chain in Southern California, which are generally much bigger in this space. And he brought along with him a team of purchasers, and the rest is sort of top and middle management. And that business, we actually, at the end of last year, sort of turned the corner. We're now cash flow break even. So when I was at Zell, one of the sayings we used to have is you have to pass through break even on your way to profitability, and so we've sort of hit that point now at Mi Pueblo. But that was a perfect example of finding a really distressed deal in otherwise non-distressed times. And some of it is luck, some of it was skill. We actually were sort of out looking for these type of opportunities. But again, it's sort of knowing that particular sector and staying focused on that. So people ask us, again, about are there distressed opportunities? And the truth of the matter is, not as many as there used to be, but by the same token, there's probably not as many guys looking for distressed opportunities either. So we think on balance, we're probably, our purchasing power is probably okay. But that's not all we do. We also do, as I mentioned, sort of conventional lending. We do growth capital. We'll do a little bit of everything. It's really, we like to think of ourselves as special opportunity guys rather than sort of pure distress guys. But we do think that there probably is catalyst coming up, and a lot of it has to do with where the debt market is. And anybody who goes to these conferences knows that everybody's talking about how frothy the debt market is and where things are at. And I've got a couple of slides that I pulled that sort of show that EBITDA multiples are sort of back at historical highs. I'll come to you in 1 second. And the percentage of debt within each deals is likewise sort of reached back up into sort of pre-crisis stage periods. And then finally, there's another wall of maturities coming, right? So we've sort of gotten through the refinancings post-crisis, and then 16 and 17, I think in the middle market, what did we decide? There was like $500, $500 billion of refinancings coming up. Companies that have done well and have, control their costs and grow the top line, they'll be able to refinance out. but there'll be a lot of companies that haven't done as well. So generally, we feel like there's opportunities in every market to find catalyst or mismanagement or other opportunities. And maybe the lack of sort of pure number of opportunities is offset by the fact that there's just a little bit less capital focused on them than there was in sort of the true distress periods. You guys, you had a question back there? Yeah.
What is your source of capital?
What is our source of capital? That's a good question. Private funds. So we manage a series of limited onshore and offshore funds. So we have what we call Fund 1, which was the first fund that we launched with. That's actually in wind down. We have Fund 2, which is really was our biggest flagship fund. Just ended its investment period. That's fully invested. We have an SBIC fund, and then we have another fund that we're in the market with and are going to close probably in the next 60 days. And then we have a couple funds focused just on this lending space that I talked about, which actually was sort of an offshoot of our main fund, but it just got too big to keep in that one fund. So it's all private cap. It's all private capital. So that's what we do. I think in some respects, very similar to other guys. I think what are the things that make us a little different? As I mentioned, we're focused on a handful of sectors. We'll look at anything, but I think we're smartest in those particular sectors we talked about. I think we're pretty creative in finding opportunities and structuring them. We really value the sourcing process because it's really sort of the lifeline of our business. And there we try and respect the partners and the service providers and the guys that we're working with. If we can give you a yes answer, that's best, but I think everyone would rather have a quick no than a prolonged and painful one. And ultimately, I think we've developed a good network of managers that we work with, because as I mentioned, that's really what we do is back management teams. Well, thank you. Appreciate it. Thanks for your time.
One comment about Jordan Allen, Victory Park Capital was, once they do give you a free return, I guess, they do get the closing pretty quickly.
Yeah. They have an excellent support staff, and they've been very efficient in the market. And it's one of the leaders in Chicago private equity. So thank you very much for participating today. Thank you, Joe.
Thanks, Joe.